So first, happy Veterans Day. And if any of our volunteers are veterans, thank you so much for your service. We really appreciate what you do. As Jeff had sent out, the practice lab is open. He provided you with the email link. For new volunteers, don't worry about it yet. We will walk you through in December how to sign into the practice lab. So don't worry about that piece of it yet. And then a final reminder, everything is not final in the practice lab. They're still working through some of the pieces. So you will see if you look at stimulus amounts, they're still looking at the 2020 versus the 2021. So just keep that in mind. Also, we sent out an email saying that the 4012s and the 6744s did arrive early. So we didn't think they'd be here till tomorrow. They are now sitting outside of Harrington Drive. Just like last year, you can come 24/7 to pick them up, and to get them, we will keep that refreshed. So they're available. Anyone from York, I will be sending you an email and we'll be making arrangements to pick up the materials. Just like last week, if you have any questions, please put them in the chat. There'll be a break. When we come back from the break, we will go through the chat questions that we have, as well as we'll cover the questions from the in-person session this morning. Once we finish the presentation, we'll come back and we'll answer the questions once again. So today we're covering income. And with that, I'm going to turn it over to Jared. Thank you.
All right. Thank you very much, Michelle. Welcome everyone to our second session here of our VITA training, and wanted to talk tonight about our taxable income. So the fortunate part, when we had discussed areas of dependency and filing status last week, there were a lot of more decision areas that we had to walk through. What was the appropriate filing status? What were the qualifications for dependency? The benefit we have today is once we identify whether or not an item should be included on the return, it's simply a matter of taking a look at the form and deciding how we want to enter that information. So the first thing we want to take a look at is what items of income would be considered taxable for VITA purposes. And good news is on your 4012, on the D1 PET tab, there's a list of all the possible items that would be taxable under the Internal Revenue Service. Now, in VITA, we're actually not going to see most of those. There are a couple areas we want to be focusing on. So just really want to talk a little bit more about the common areas. We're going to be talking tonight about salaries and wages. That includes anything that you're getting from either an hourly perspective or a salary amount. We're going to talk a bit about alimony. And alimony, while there have been some changes in the past, if anyone has had a divorce that was completed prior to December 31st, 2018, those would be considered taxable alimony payments. So the general rule we have, if an individual has been filing their return and reporting alimony income, we will continue to report the alimony income. There's no change for their current benefit. The only change we have is if there was a new divorce or a substantial modification of that prior divorce. So the alimony would still be taxable here in 2021. We're going to talk a little bit about annuities. We're going to end our session a bit today on business income, which would be an advanced topic that we'll be covering. So if you're just going for basic certification, we don't really need to worry too much about the business income component, but we just want to present that for those people who would be interested in going with the advanced certification. A couple other things that we want to take a look at. We'll also be talking about some debts forgiven here, and also being sure that we can talk about some investment activity, including dividends, employer-funded disability benefits. Those are going to be things that we're going to be talking about in terms of areas that'll be taxed. We're going to talk about gains from sales of properties and securities, also gambling winnings, talk a little bit more about interest, again, in kind of that connotation with dividends. We're going to spend a lot of time this evening on IRA distributions and those retirement benefits. So that includes Social Security and any other type of pension or other taxable item being reported to us through a 1099-R. Typically, what we're going to be reviewing here as well is taking a look at other opportunities as well. That would include jury duty fees. Those are going to be taxable, as well as non-employee compensation, gambling winnings, those types of things as well. We will go ahead and also discuss areas of Social Security benefit. Again, another big one we'll be reviewing tonight. Also, just want to mention tips and gratuities are also going to be considered. Our benefit is going to be taxable. So if people are reporting tip income, they need to be reported on the income tax return. So just wanted to be sure that we're covering a lot of these items. Generally, most people are going to be coming into VITA with forms provided to them from their employer, from their investment broker, from their retirement plan. Another one we want to highlight again is unemployment compensation. So you'll see it at the very bottom of this list. It is in red, it is in bold. It is taxable for 2021. In 2020, we had a very, very late change in the government's position on unemployment compensation, and quite often happened after we had filed a majority of our returns. But last year in 2021, eligible taxpayers were able to exclude unemployment compensation provided their income was beneath $150,000, which is obviously within the VITA scope. They could exclude the first $10,200 of unemployment compensation. Now, fortunately, the government went ahead and did a corrective action. We did not need to file amended returns. Again, as I mentioned, most of those returns probably had been filed well before the change had actually occurred, and we had to wait for software updates and everything else. The unfortunate part, for 2021, we do not have an exclusion provision yet on unemployment compensation. So we're still anticipating that we're going to have the full amount of unemployment be taxable here in 2021. So we will keep you updated if any late breaking changes occur. But at this point in time, all unemployment compensation will be considered taxable income. So that's kind of the bad news. What kind of income is going to be subject to tax by the government? What are we going to be reporting on the Form 1040? But there are a lot of areas that are not taxable. So we're going to talk about those as well. Those are found on the bottom of D1, slightly smaller schedule because there's really a few items that are going to be considered exempt from tax. Big ones are going to be things like child support. So alimony, again, if we're seeing a existing divorce agreement, alimony payments are taxable, but child support would not be. Another trend we're going to see here are damages for physical injury. So typically when we take a look at income, if you are being compensated because you're unable to work due to illness, sickness, disability, those amounts are not taxable. If you're being compensated for actually performing work, or you could work, but you don't have a current job, like the unemployment compensation, those are taxable items. So again, damages for physical injury would be exempt. We're going to talk about sickness and injury payments that are exempt as well. Federal income tax refunds. So that includes refunds that people had received in a prior year. Also, if people ask about, well, how much of my stimulus money is going to be taxable, or if they said I didn't apply for a stimulus because I know it's going to be taxed, that federal income tax refund, as well as the federal stimulus money, is not taxable for federal income tax purposes. Another big question we often get within VITA is how much do I need to pay if I have a gift or received an inheritance? And the good news is that those amounts are not taxable to the recipient. So if you receive a gift, if you receive an inheritance, those will not be taxed for you. There may be some consequence from the donor, the person giving the gift, or to the estate of the person who passed away. But from the recipient, there is no tax at a federal, state, or local level. You have insurance proceeds. If you had gotten money from an insurance company due to damage you had sustained at your home, in a vehicle, if they're property, they are not taxable as well. So that would also be a tax-free item of income. If you have municipal securities, those would be tax exempt for federal purposes. On our chapter 4 or 4th session we'll have here, we are going to talk about the state impact for tax exempt municipal bonds, but that may vary depending on what you hold and the investment underlying there. But from a federal perspective, if you're investing in municipal bonds, that's also going to be exempt from an interest perspective. Much like we talked about any sickness and injury payments, including supplemental Social Security income, would be exempt because, again, they're payments for the inability to work. Welfare payments, food stamps, again, government assistance programs are not taxable. Workers' compensation, again, because you're getting compensated due to an injury occurred on the job, that is not taxable, but unemployment compensation would be. So again, if you cannot work due to injury, sickness, or disability, the payment's typically not taxable. If you're able to work but cannot, then that obviously from an unemployment compensation perspective would be considered taxable. So we went through a fairly long list of what is and what is not taxable. The good news is, like I mentioned, most of these items are going to be coming through on government forms. So the primary ones that we're going to see coming through on the Form 1040, and the fortunate part, all of this information is reported on page 1 of the 1040. For those of you who may have been preparing returns in the past, we had a year where all the income information moved to the second page. Fortunately, as last year, it's still back on page 1. So the most common forms of income we're going to see actually kind of align very nicely with the Form 1040. Wage income, a Form W-2, which we'll show you in just a little bit, would be on line 1 of the 1040. Interest income coming through on a Form 1099 INT would be on line 2B. Dividend income would be coming through on line 3B. IRA distributions, retirement distributions coming through would be on Form 1099-R. That would be on line 4B. If you have a distribution from a pension or annuity, that would also be on a Form 1099-R. That would be on line 5B. And Social Security benefits on a SSA Form 1099 would be on line 6B. So these are going to be where the income ultimately shows up on the income tax return. But when we take a look, we'll show you where the input will go within the software system and show you the forms of how you're going to pull that information to be able to enter it. Just before I move on, I just want to make a mention here that when we take a look at this top page, we're going to see a lot of the Form 1099 in various components. So you'll see 1099 INT, 1099 DIV, 1099-R, SSA 1099. These are all forms that are reported to the recipient. They are also going to have a copy go to the federal government. So what we want to be sure is if one of our clients comes in through VITA, that we report all of the income shown on the Forms 1099. If we do not, the taxpayer may get a notice from the government a couple months later when they try and match the income that they're aware of with what was reported on the income tax return. And fortunately, the government does have a fairly nice naming methodology. You'll see the INT for interest is going to stand for interest. The DIV is going to stand for dividend income. The R is going to be for retirement distributions, and the SSA for our Social Security Administration. So those are going to be predominantly forms that we're going to get from the client, going to be issued either from their employer, from their bank, from their retirement provider. We also may have some additional items of income that'll be on a Schedule 1, which actually then comes over to a different line on the Form 1040. Again, some things we may have are alimony monies received. That would be on Part 1, line 2A. We wouldn't need to put the date of divorce. We had that same requirement last year. So typically, if they're either going to bring the return in from the prior year from an outside preparer, or if we had prepared the return inside VITA, that information should be coming over. Unemployment compensation has its own line. That's going to be line 7 of Part 1. And then at the end of our session today, we'll talk about a little bit of other income as well, which may include things like gambling winnings and jury duty pay. But just wanted to go through and show a couple things here on the forms that you might be seeing for the current year. So wanted to first take a look and see if we can show you the Form the Form W-2. Now, just want to kind of point out a couple things with the W-2. Unfortunately, while all these boxes will be standardized, the Form W-2 may be a little bit different. We're going to show you one here that's kind of a traditional type W-2 form. These are the longer forms, kind of about a half page in length. The important things we want to pull in here is to get the employer identification number and also identify whether it's the taxpayer or spouse that we're working with. So we're going to take a look and just be sure that we can identify that when we enter the information into our TaxSlayer system. So good news with our TaxSlayer system, if the client had come into VITA before and they had elected to have their information carry over, all of their prior information, including their employer, their bank, their retirement accounts, all should be flowing over to the current year. So you don't actually have to re-enter all the data. Now, the other issue, if it's a brand new client or maybe they've added a couple W-2s for the year, Once your site has entered a W-2 in, and you enter the employer identification number as shown here in box B, that information for the employer and the address will all pre-populate. So really cuts down on a little bit of data entry. So if you're in an area and you see some similar W-2s coming in, maybe it's a local hospital or manufacturing facility, once you get a standard W-2 in, it's going to go ahead and pre-populate some of that information. But as we take a look at the form, there are a couple things that we just want to point out. When you get a W-2, you want to enter the information exactly as shown on the W-2. So that includes, again, just verifying that we have the appropriate taxpayer. We want to be sure that the address on the W-2 is entered into the tax layer program, even though their current address may have changed. So we want to try and get the W-2 as close to possible as matching, so the IRS has a much easier time getting that information reconciled. The other thing that we notice is that the primary information will be coming out of box 1. So again, depending on the W-2, the format might look a little bit different, but box 1 on every W-2 will contain the amount of federal wages that will be taxable. So we're going to want to enter that information into our tax layer program. Immediately next to it will be the amount of federal income tax withheld. Tax layer has a tendency to want to auto fill in Social Security wages and Medicare wages. In some cases, they're going to be exactly the same as federal wages. We just want to verify that the amounts that are entered are going to be the amount that's shown on the W-2. So it'll automatically calculate Social Security and Medicare tax withheld. But there may be times, particularly in Pennsylvania, where if an individual has a contribution to a retirement account, that their federal wages are going to be a little bit different from their Social Security wages. So if that's the case, just simply go ahead and type the correct numbers in boxes 3, 4, 5, and 6. Just want to point out that there is box 10 here, which is our dependent care benefits. So oftentimes that amount may be a little bit harder to see. We don't always look for that, but it is a very important box. That is where an individual has selected on a pre-tax basis to defer some of their salary to cover costs for their dependents. So we'll talk a little bit more about that, where that goes next time when we talk about credits. But it's important that we actually enter all the information from the W-2. Underneath here, we'll see that we have boxes 12A, B, C, and D. These boxes are ones that we do want to enter into the software as well. So typically within these boxes, you may see contributions to a retirement account, typically a code D or code E. We may see amounts that are used for HSA or health savings account plans with the code W, amounts that may have been paid for health insurance with the code AA. Anything in box 12, when you put this information in, if you enter it as exactly shown, it will flow to the correct parts of the 1040. It'll actually go and complete the calculations that the system needs to do. In box 13, predominantly the one thing we'll take a look at here is just whether or not that retirement box should be checked. So if we're going ahead and entering a code over here in the 12A or 12B, it's a code D or code E, the box should check, but just make sure if they are participating in a retirement plan that box is checked. Some of our W-2s, particularly here in Pennsylvania, will probably show other information in box 14. In this case, we have a local services tax and a state unemployment payment by the employee. You may see things like retirement plan contributions by educators to PEASers. None of the information in box 14 goes anywhere. So you do not need to enter any of that information in box 14. You may need some of that information later for preparation, but you don't need to enter it into the tax software. Just to finish off the W-2, we do want to make sure that we have a state return selected. And also there may be a difference in the state ID number. So it may not always be the federal identification number, particularly if we're looking at different states. Again, taxpayer will want to go ahead and normally fill in the state taxable wages to be the exact same as federal. Again, we may have a difference here in Pennsylvania with a retirement contribution that would be deductible for federal purposes, but not for state. So we may have a different state wage line than we would for box 1. So again, we just want to enter that in as it's shown. So that would be our box 16 along with the withholding. We would also make sure that our local wages are entered in appropriately along with the local income tax withheld. And the recommendation, if we're going to be preparing local returns, is to enter a code of 36. 36 is a state code for Lancaster County. For those in other counties, maybe you want to enter a different locality code or enter the one from the W-2 if there is one shown. But when we get to the tax program, we'll show you how we can actually prepare a local return by linking the W-2 directly to the local return. So the W-2 actually has a fairly good amount of information on it, but the nice part is that TaxSlayer handles W-2s very well. So once you go ahead and you identify whether it's a taxpayer or spouse, you can go ahead and enter the information into the tax program, and it should go ahead and do the automatic calculations. So the next form we just want to talk about here is a 1099 INT. Again, INT is going to stand for interest. We can go ahead and take a look at the form. It's going to be basically either taxpayer, spouse, or joint ownership. So you can just indicate that whenever we enter the information. Predominantly, we're going to see interest income appear in box 1. That's going to be our amount of taxable interest for federal purposes. If the individual had a early withdrawal from a timed account, like a certificate of deposit, that would show up here in box 2. That can be entered. That is a deduction. You do not need to itemize your deductions in order to take a early withdrawal penalty. Just a note on interest on U.S. savings bonds and treasury obligations. If you do have an amount, please go ahead and enter that in. Interest on U.S. savings bonds is taxable for federal purposes, but it is not taxed for state purposes. Now, you may not always see a 1099 INT come through. If a client says, well, I have money at the bank, I did not get a 1099 INT, I'm not quite sure what to do. Well, first of all, the 1099 INT is only issued if a recipient receives $10 or more of interest income. So quite often under VITA, we may not see a lot of people coming in with 1099 INTs. Given the interest rate of the banks today, the propensity for most of our clients to not have a significant amount in savings is not unlikely that they will not reach a $10 interest threshold. Now, if they have an account maybe with a local credit union or savings and loan that pay a little bit higher rate of interest, they may actually have the 1099 INT, or they may bring their bank statement in and just show us how much interest they earn for the year. If that's the case, we can go ahead and just certainly enter that in to the TaxSlayer program. So similarly to interest income, we also have a 1099 DIV, which is going to be used for purposes of our dividend activity. Now, in this case, again, we just want to take a look at the recipient. Is it the taxpayer or the spouse, or is it a joint account? And just select the appropriate ownership. A couple things we just want to point out here is for our total ordinary dividends. In this case, we have $1,256. That amount is going to be taxable. So that's the amount that's actually going to show up on line 3B of the 1040. Now, there are a couple other things that we may see. There is a concept here of qualified dividends. Qualified dividends are effectively for individuals who have held security for a sufficient period of time that they qualify for special tax rates. So with a qualified dividend, that amount of the whole dividend, in this case, $1,100, is going to be taxed at a different rate. So that could be as low as 0%, or it could be 15%. You can go up as high as 20%. But most of our clients within VITA will probably be at the 0% rate for qualified dividends. Again, you don't need to worry about that. The system is going to go ahead and do the calculation for you. But it is important that we make sure we have the qualified dividends indicated. If we have investment in just a plain stock account, that may be all that you see, just ordinary dividends and qualified dividends. However, if people are investing in a mutual fund or ETF or other type of fund type investment, we may see that there are other items that we need to fill in, such as capital gain distributions. So capital gain distributions would just, if you see it on line 2A, you enter it in. It's automatically going to go over with the rest of our capital gains and losses, which we'll talk about in just a minute. We may see a couple other things. Typically, we don't see federal income tax withheld on the 1099 INT or DIV, but you just want to double check that. We may see with a more managed brokerage account, there may be some foreign taxes paid and some foreign activity that we need to capture. We'll talk a little bit about that in our credit section next time. But one area that we might be seeing is a ability for us to have a couple different boxes, and that may include things like a section 199A deduction. Again, as you see information on the 1099 DIV, simply just go ahead and enter that into the software program. Now, another one that we might be seeing a little bit more often is the unemployment compensation. As we mentioned, this is taxable in full at this point for 2021. Again, we just want to identify to make sure whether it's the taxpayer or the spouse. Again, good news is the first person at your location to enter it will be entering the federal identification number as well as the PA Department of Labor. For those of you who have done returns before, we're pretty much well aware. This address is actually 651 Boa Street in Philadelphia. I'm sorry, in Harrisburg. Once someone enters that information, you enter the identification number for the PA, the Commonwealth of Pennsylvania. That will automatically populate. You don't have to enter any additional information for the background. We simply just want to enter the unemployment compensation from box 1. Now, I do want to point out that you do have the opportunity, if you're collecting unemployment, to have federal income taxes withheld. So you just want to double check box 4 to make sure that any federal income tax withholding has been appropriately accounted for. Again, because as we see that the unemployment compensation at this point is going to be taxable in full, hopefully we have some federal income tax withheld to offset that. Now, the other form that is going to be fairly popular for us to work with is going to be the form SSA 1099. And this form is going to be reporting the amount of benefits taxable subject to tax for the current year. So what we have is a couple different pieces. So we want to identify the individual and their social security number, again, making sure we have the right taxpayer or spouse. The amount that we want to enter in is actually going to be the amount here in box 5, which is going to be, if we did this in color, would be an amount that is kind of a salmon color, kind of maybe a light tangerine. My sense of color is not that great, but somewhere in the light pink to kind of orangish hue is the main number that we'd want to see for the benefits to enter into our tax software. Now, Social Security could be taxable at 0% all the way up to 85%. Again, when we take a look at filing status, if we're married filing separately, a greater percentage of your Social Security will be taxable. We do just want to let the software take that into account. We don't need to do any calculation as long as we get the information in correctly. Now, we don't often see it, but we do just want to double check to see if anyone has any voluntarily withheld federal income tax. That would be reported here in box 6. There could be some additional information in box 3. That may include things like our Medicare premiums and any of our drug benefits that have been withheld from Social Security. So that would allow just us to go ahead and enter that information in directly with the Social Security statement. There's actually a piece you can enter that in. Typically, unless you're itemizing deductions, this really won't help out too much, but it's always worthwhile to go ahead and enter that information as you see it. So fortunately, the SSA 1099, no changes to the prior year. The government did not change any items of taxable income. They didn't exclude anything new. So everything we've done in the past, we'll be doing again for the current year. Now, the big one we want to talk about is the 1099-R. So the 1099-R, as you can see, is designated for a retirement distribution. It's going to be coming from a pension, annuity, retirement, could be a profit share, an IRA, could be insurance contracts. There could be a lot of different things coming through on a 1099-R. So we're going to go through and just kind of point out a couple features here on this. And then I'm going to go through a little bit more explanation of codes and a couple other things along those lines. Again, we want to identify who the taxpayer is, whether it's a taxpayer or spouse based on the taxpayer Social Security number. We are going to enter that information using the EIN of the payor. Typically, what you're going to see, the most common forms we're going to see on the 1099-R, you're going to have an amount in box 1. You may or may not see anything here in box 2A. If it is blank, we're going to tell you what to do with it. If there is a number there in box 2A, by all means, go ahead and enter that in to the tax software. So you want to be sure you're entering in the amount from box 2A. You'll see here in box 2B, there are actually two different check boxes. One is a taxable amount not determined, which would typically indicate that this box 2A would be left blank, or you may see the phrase unknown in there. That may not be a big problem. We're going to talk about what to do with that one. Total distribution means that this is the last 1099-R that the individual may be receiving. And it could be that they've taken all their money out of the account, or perhaps they've rolled it over to a new account. A couple other things that we may see would be federal income tax withholding. So the amounts distributed from a retirement account, annuity account, pension account are taxable for federal purposes. So we may have a tax liability arising from it. So if the amounts are significant, hopefully the individual has had withholding. These are usually a little bit more easy to control than withholding from Social Security statements. So if we're going to see withholding from a retiree, it's more likely going to happen here at the retirement level on 1099-R. Just to make a quick note here, for the 2020 year, the IRS actually suspended what is called required minimum distributions. These are a required amount coming out of your retirement account. So that was actually suspended during the initiation of COVID. That was for the 2020 year only. So for 2021, required minimum distributions are now back in. So if someone did not provide a 1099-R in the prior year, it may simply be for the fact that they did not take their distribution and they did not have to. So that's entirely fine, but we should be expecting one if they had taken any distribution. So a couple other pieces we're going to talk about a little bit later are box 5, which would be any employee contributions. We're also going to talk about line 9B, which is total employee contributions. But the big thing I really want to focus on for the next couple of minutes is really the distribution code piece. That's going to be in box number 7. In this case, you can see that there's a distribution code of 1, and we'll talk about what each of these means here in just a minute. You'll also see that there is a check box next to it here to say IRA, SEP, or Simple. The main reason for this is just to help indicate where on the 1040 that amount should be going. So if it's an IRA distribution or a SEP or a Simple, that's going to flow to line 4B of the 1040. If that box is not checked, then the amount that we show as a taxable will go to line 5B. Again, we don't really need to worry too much about it, just making sure we're entering the information as shown. Now, when we take a look at the 1099-R on the surface, it really doesn't appear to be that much that's overly difficult with the form, and they're really not. They're fairly straightforward. We typically have a gross distribution. Maybe we'll have something in box 2A, something in withholding, and taking a look at this code's distribution in box 7. So this is where we see a lot of differences. So the codes that we would typically take a look at were within the scope for VITA. And again, this would be on D40 of your 4012. Would just want to present a quick chart that we put together here. So I want to show you what the description would look like and then what the impact would be for state and local taxes. Again, we'll cover a review of state and local taxes in our 4th session, but wanted to give you kind of a quick preview. The one that we don't want to take a look at all that often, the one that's least advantageous for our clients is a code 1. It's an early distribution and no known exception applies. In most cases, it's because the individual is under 59 and a half. Not only is that income taxable, but we're going to talk a little bit later about that might be subject to an early withdrawal penalty. The second code is an early distribution, but an exception applies. The administrator knows that the individual is under 59 and a half, but there is a reason why they took the money out of their account, and it would not be subject to penalty. Now, both codes 1 and 2 technically are taxable at the state and local level. Under Pennsylvania law, you actually get to recover your cost basis first. So whatever you had put into your 401k or your IRA, you get to pull that money out tax-free. Main reason is Pennsylvania does not give a deduction for contributions to your retirement account. So your own money that goes in can come out first. And we'll talk a little bit more about cost recovery. The rest of these are pretty much not taxable for PA purposes. That would include areas of disability or death. However, these are taxable for federal purposes, but there's no penalty. You'll see that we have a couple things in red and bold here. These are technically outside scope of VITA, but I do want to mention what those are going to look like here in just a little bit in terms of how we would treat a code 6 or a code W. If you were preparing a return and we're able to do that, or if you're taking advantage of our friends and family opportunity within VITA, even though we may mention a couple things are outside scope for preparation for clients. If you're doing a friend and family return or your own return, you have full access to the program. You can actually do returns that are not technically within our certification scope. So you may certainly be able to do these for your own returns or friends and family, and we'll have a discussion of how that'll look as we approach the season. The one that we may typically see would be a code 7. That's a normal distribution. It's effectively someone who's reached retirement age. They are taking a normal retirement distribution. It could be a minimum amount, it could be the entire amount, but they're basically going to be subject to tax on the taxable portion. Here in Pennsylvania, we do not have a tax on retirement distribution, so that would not be taxable. Another one would be a Code G. Now, a Code G is actually a tax-free rollover from one plan to another. So if it's going immediately from one plan holder to another, what we call a trustee to trustee rollover, we would be getting a 1099-R, a Code G. It's not going to be taxable for federal, not going to be taxable for state or local either. And that has to be a direct rollover. Now, that can also occur if we have a Roth account. And a Roth account is a little bit different. We've had these for the past couple of years, but if you roll your Roth account from one provider to another, you will get a 1099-R with a code H. Again, it's important if people get 1099s that we report that on the tax return. Otherwise, they might be getting notification from the government a little bit later that they may have forgotten to report some income. Now, the one that we'd like to see with the Roth IRA is the code Q. That means it's a qualified distribution from the Roth IRA that is not taxable for federal purposes, also not taxable for state purposes. I'm going to talk a little bit more about this code 7D or a D7. This is a earning on a non-retirement annuity. Now, again, it is going to be taxable for federal, and I'm just going to talk a little bit about what that means for Pennsylvania purposes. So a couple of different codes that we have, a code 7D or a D7, depending how it arises, is a mixture. It's actually a number and a letter. So the 7 means it's a normal distribution, but the code D means that it's actually earnings on a non-retirement annuity contract. So typically where we see a non-retirement annuity, it's actually an investment product typically sold by a life insurance company or other type of financial company. Basically, it's a structured payment plan. What effectively happens with an annuity is the annuity holder will give money to the insurance company or retirement company or investment company, and they will give them a series of payments at some later period of time. Now, these payments coming back partly are the annuitant's monies and partly earnings. So the earnings portion are going to be shown in line 2A. That's going to be the portion that's going to be taxable. That's also going to be taxable for Pennsylvania purposes because it's a non-retirement annuity. Pennsylvania is going to treat this as interest income. So fortunately, we've had very good luck in the past that if you're entering the code 7D or D7, that Pennsylvania will pick that up as interest income and be taxed appropriately on the PA 40. Another one we may see, although not that often, is a code F. Code F is a charitable gift annuity. So sometimes people may want to go ahead and give excess money to a charity. Typically, we can see different ways in which that annuity can be provided. Typically, it might be monthly payments or annual payments to a recipient. Upon their death or upon a period of time, it goes over to the annuity. Again, much like a non-retirement annuity contract, any amounts in line 2A are also going to be taxable for Pennsylvania. So code F, 2A is going to be taxable for federal and also going to be taxable for Pennsylvania. Do want to mention again the code 4. Code 4 would be a amount received as a beneficiary. So effectively, you're inheriting a retirement account. Even if you're under age 59 and a half, there is no early distribution penalty. So none of that applies if you inherit an IRA from a grandparent or an aunt or uncle or a parent. You can withdraw those money. It's still going to be taxable for federal purposes, but not subject to a penalty. For state purposes, for Pennsylvania, any code 4 is not taxable for Pennsylvania or local purposes. They actually allow that to be withdrawn without a tax on the distribution. Now, I mentioned there were a couple codes that were kind of redded and bolded. These are technically outside scope for VITA, but I do just want to make a quick mention because we do see these on occasion. Code 6 is representing a exchange of life insurance or an annuity or long-term care insurance. It's basically you're changing your insurance carrier. Maybe you've changed your carrier, maybe you picked a different plan, but it's effectively a tax-free exchange of life insurance. So it happens again, typically if you change insurance brokers or insurance companies and you change your policy, they'll issue you a 1099-R with a code 6. Now, again, typically not taxable. So no problems for federal or state purposes or local. However, Pennsylvania typically will have you add these amounts back for the Schedule SP and the PA 1000 property tax rent rebate claim. So it may have some impact here for Pennsylvania tax forgiveness or the rent rebate program. The Code W. Code W is typically when you're taking money from your qualified plan and you're actually purchasing qualified long-term care insurance. So that could be coming out of an annuity, it could be coming out of a life insurance contract, but you're basically taking money out that you would have been able to be entitled to and purchasing long-term care insurance. Typically, these amounts under Code W are going to be tax-free, again, for federal, state, and local purposes. So when we talk about pensions and annuities, what we're looking at here are any of these 1099-Rs are typically going to be coming out of any type of pension and annuity payment. So you may have heard of the 401k for for-profit companies. A 403b is typically for not-for-profit companies, might be schools or hospitals. For government employees, they may have a 457b plan. So these are going to be the 1099-Rs. These are distributions where we typically would not see the IRA separate simple box checked on line 7. So typically with these plans, all the distributions are going to be fully taxable. So as long as no after-tax contributions were made to the plan or all the costs were previously recovered, it's going to be fully taxable. So if you see an amount on line 1, enter that amount. If you see a line on line 2A, enter that amount as well. Now, there could be some exclusions for insurance premiums for retired public safety officers, so what we call a PSO. So if the individual was able to participate in a retirement plan through their service, and they had taken a portion of their retirement benefit and used that to buy insurance for either themselves or their spouse or dependents, it could be health insurance, dental insurance, accident, long-term care, they can actually get an exclusion from income. And it's going to be the smaller of the premium you actually paid or $3,000, whichever is less. If you're in the tax program, there's actually a screen. If it says calculate your taxable income, click on that button and it'll go to the next screen and is eligible for our public safety officers. And when we take a look at public safety officers, what we mean by this definition would be anyone who is in law enforcement, firefighter, chaplain, member of a rescue squad or ambulance crew. It may include individuals from government service, including military police, Department of Defense employees, certain prison guards, or U.S. Marshal Service. The individual should know whether they qualify for the PSO exclusion. Typically, they'll get a letter or some sort of form from the retirement service indicating how much they've had for insurance. So the smaller the premium paid or $3,000 is going to be excluded. Just want to let you know if the amount was higher, enter that amount in for the PSO because any excess amount will then be carried over to be considered qualified medical expenses. So the system's going to go ahead and take the smaller of the number, either the premium paid or $3,000, and exclude that from the retirement taxability. I mentioned that there might be partly taxable annuities or other types of payments. So when we typically take a look at those annuity contracts, part of that payment you're getting back, again, might be your own money you put in. So if you see an annuity or other type of pension, we may have a different amount on line 2A. As I mentioned, please go ahead and use that amount on 2A. So enter that amount. That's going to be the amount that will be considered taxable for federal purposes. So there may be a couple other issues we have. Sometimes we may have a situation where the retirement plan may not be shown in terms of taxability. So what happens if that's the case? Certainly, if there is an amount in box 2A, as I mentioned, go ahead and enter that. That'll automatically carry over to 4B or 5B. But sometimes there's not an amount reported in box 2A. Sometimes it's just a amount in line 1, box 2A is blank, or maybe it says taxable amount not known. So you see an unknown in box 2A. At that point, you simply ask the question with the taxpayer, did you make any contribution to your retirement account, 401k, thrift plan, 403b, 457, with pre-tax dollars? If all the amounts were pre-tax dollars, we're fine. That distribution is going to be fully taxable, even though there's nothing in box 2A. the system will automatically assume that the amount in line 1 should be taxable for 2A. The only way to override that is if you put a 0 in. So don't put a 0 in unless you know none of it is taxable. The system should go ahead and pull that over automatically. Now, if the individual gets back and you say, did you use any after-tax dollars to fund your retirement account? Hopefully the answer is, I have no idea what you're talking about, because that means they did not make an after-tax dollar contribution to the retirement account. If they did, and there's no amount indicated in box 2A, this becomes more complex, because if they used after-tax dollars, then only a portion of that distribution is going to be considered taxable. Unfortunately, that calculation is relatively complex and is outside the scope of VITA, so we cannot prepare that return. So in the rare circumstance where you ask someone, did you make any contribution to your retirement account with after-tax dollars, and say, yes, I have. I had done a couple $100 a year about 20 years ago over a series of years. Unfortunately, what you're going to have to do at that point is very politely gather up all the documents the taxpayer had given you, slide those across the desk, and thank them for coming in. But we unfortunately cannot prepare that return. The calculations are just too complex for us to be able to work with. On a Roth account, typically the Roth distributions can be tax-free if the following conditions are met. So we have a distribution made 5 years after the first contribution was made. The distribution is happening because the individual's at least 59 and a half, due to disability, due to death, or maybe a first-time home buyer amount. And first-time home buyer is kind of unique. I'll talk about that with some exceptions in a little bit. But as we may have been able to tell from week 1, the IRS's definition of terminology may not be exactly what we think it is. Now, if the distribution is made 5 years after the first contribution, the taxpayer is 59 and a half, we have no problem. It's going to be tax-free and typically would have a code Q. If the tests are not met, then the distribution can be partly taxable. Again, the calculations are relatively complex, and that would be outside the scope of VITA. Now, one other interesting wrinkle, and again, I don't want to make anyone feel that the 1099-Rs are overly complex. Generally, we're just going to use the information we see. The question arises if there's nothing in box 2A. We just have a couple other questions we may want to go through, but typically that should not be a problem here for the individuals. So when we take a look here at what happens if there is an investment in the contract. So when we took a look at that 1099-R, I mentioned that there might be something sitting on line 9B. So these amounts on line 9B are all the after-tax amounts, or the premiums or contributions that the individual had paid in their investment. So those are actually going to be amounts to be recovered tax-free. So line 9B in the first year payments to receive should be showing how much we'd have in total after-tax dollars. So we could fortunately use something called the simplified method rule. So typically it has to be used if the annuity started after July 1st, 1986, or we've used the simplified method in a prior year. Now, hopefully, we're not going to find anyone coming in for VITA who has not filed a return since 1986, and we have to go all the way back to that time frame. Also, it applies if the annuity started after November 16th, 1996, and it was coming out of a qualified plan, and they were under the age of 75, and they're guaranteed under 5, or the number of years is fewer than 5. Suffice it to say, the predominant opportunities we can use the simplified method if it exists. The area that I've seen this work a little bit more frequently in is where we have a government employee who may have made contributions to their qualified employee plan with after-tax dollars. They have an investment in it, or they might have had a qualified employee annuity or tax-sheltered annuity with investment. So the first year they're going to start it, we're going to see something sitting in line 9B. So if we have that existing, we can use the simplified rule. If for some reason we cannot use the simplified rule, then we have to go to the general rule. A lot more discussion of that we found not just in your material in the 4012, but also in the pub 939, which we have indicated down here if you need more information. Again, if you're getting into more complex transactions, by all means, do not feel like you have to prepare the return in full when the taxpayer is there. Some of it may take a little bit more time. So if we are using the simplified method, typically what we need to know, if they've used the simplified method for prior years, we have to get a copy of that prior Form 1040. Again, if they've already been coming to a VITA site and they've elected to have the information carry over, that information will already be in our system. If they went to an outside preparer, we just need to take a look at the prior year return to determine how much of their annual payments would be considered tax-free. We'll also have to know for the first year, what type of annuity payment program do they have? Is it a joint life? Is it a single life annuity? We'll need to know the age of the recipient. If it's both recipients, we're going to have both ages, but fortunately that information is captured when we go through our intake process. We already have the taxpayer and spouse's dates of birth indicated, so that'll help us go through and do the calculations. So again, if you're working with the Pub 939, it'll go through the tables. You're more than welcome to try and do the calculation on your own. However, I highly recommend that you use the software. The software knows what it's doing. Yeah, for the most part, we'll let you know if there's any issues, but if you're entering information, it'll automatically use the appropriate table, a single life or joint life, as long as we indicate the correct type of plan. If it's a fixed term rather than a life annuity, we can just simply enter the total amount of payments under the contract. Once we do that, the calculation will actually occur relatively simply. So just want to go through kind of an example of where we may see this. So if we have a client coming in, Bill Smith, age 65, he just started receiving his retirement benefit in the current year, 2021, under a joint survivor annuity, started January 1st, 2021. The benefits are going to be paid for the joint lives of Bill and his wife, Kathy, who's also age 65. Bill's going to have $31,000 of contribution. Again, that would be the amount we'd see in box 9B of the Form 1099-R. So he's made $31,000 of contributions to the plan after tax. He has no distributions before the annuity start date. He's going to get $1,200 a month. After he passes away, his wife's going to get half that amount. So what we're basically showing you here is an example of how the simplified method would come into play. We're going to get a 1099-R. It's the first year of Bill's taking a distribution. We see there's an amount sitting in 9B. So we're simply going to enter that information in under the simplified method. So again, we'll only have to do it for the first time if it's the first time they're taking that distribution. If they've been taking distributions before and using the simplified method, that information should carry over. All right, so going from the area that we're kind of working with people who have been in and they kind of know what's going on, just want to talk a little bit more about some penalty situations. These are going to be ones in which usually we have a couple different issues occurring. We may see more early distribution penalties from retirement plans. Typically, this is going to be, you're going to see that there is a code 1 in box 7. You may see the 1099-R has line 2B checked, meaning it's a complete and total distribution. Where this typically arises from is we're seeing a little bit more of a prevalence as employers are now moving to an automatic enrollment for retirement planning. So many employers now would basically, rather than give you the election of whether or not you want to participate, mainly have a process where you have to elect out of the retirement plan if you're working for a company. So you would have to tell them, I do not want any monies going to my retirement plan in order to not participate. Otherwise, the company, after you meet eligibility, will automatically enroll you and start having monies taken out. Well, typically what happens if you leave employment, you have a couple choices of what to do with your retirement dollars. And I've seen this. My own kids, for their summer jobs, have been with employers that have automatically enrolled them. And once they go back to school, they're no longer working with the employer. Now they have 3 options. Option number 1, you can leave the money in that retirement account with the employer. Generally not a great idea because you have to keep track of that account. And also the employer may not have to do that. If your account's beneath a certain threshold, could be $5,000 or less, the employer could say, we're not going to hold on to your money. You have 2 other options. Option number 2 is you can roll that money into a different plan. So you can take that money from a retirement plan and have that automatically go over to an IRA or a new employer. That would be what we consider a direct rollover. And you'd be getting a 1099-R and have a code G for a direct rollover. Option number 3 is you may elect to take all the money in your retirement plan and take cash. So not the best option, but when presented to an employee, a couple of the things that we take a look at here are you're basically taking a look at a younger employee and you have the option to say, would you like to take this money and put it aside in an account that you won't touch for 40 or 50 years? Or would you like to get a couple $100s in cash today in your hand that you can use for whatever you want? You can use it to buy clothing, go out for a nice meal, go on vacation, buy some electronics, whatever the case may be. So when we go ahead and we take a look here, unfortunately, a lot of employees go with the third option. They're going to take that money out in cash. What that means is they're going to get a code 1 in box 7 from their 1099-R. It indicates it's an early distribution. They have not yet reached retirement age. They're not yet 59 and a half. There's no known exception that applies. That money will automatically be subject to a 10% early withdrawal penalty. Now, we don't need to do anything in TaxSlayer. What we may ask the individual is, I see that you have a distribution from your retirement account. You did not hit retirement age. Can I ask what was the purpose behind the withdrawal? And if they say, hey, the employer told me, they weren't going to hold it. I had the option of taking in cash. I used it and I helped put money down on a new car. That's great. We'll just let the system calculate the penalty. We do not need to actually prepare a form 5329. Now, as I mentioned before, Pennsylvania and local will also tax an early distribution. Pennsylvania is going to be treated as compensation, same thing as local, that's going to be treated as other income. As we mentioned, any employee contribution to the plan are tax-free, so we actually get to pull those out first. So if an employee has a balance in their account of $5,000 and they pull $2,000 out, we're going to get a 1099-R, $2,000 taxable, code 1 in box 7. But if we take a look at their prior W-2s, again, taking a look at that box 12, a code D or a code E could indicate how much they've contributed. And if they've contributed $3,000 to their plan, and it went from $3,000 contribution up to $5,000, and they've only taken $2,000 out, all $2,000 is tax-free. If their account balance is $2,000, they take the full amount out, they only had $1,000 of contribution. We're going to have $1,000 is going to be tax-free and $1,000 will be taxable. If you have questions on the cost recovery method, go ahead and feel free to talk to your site coordinator, particularly here in Pennsylvania, kind of a unique rule of how that works. So we just want to be sure everyone's comfortable with that process. We don't often have that, but fortunately, the information, generally, if the individual's only worked for a year or two, we probably have that readily accessible. Makes it a little bit easier to work with. Now, when we talk about the early distribution, there may be a valid reason why a distribution was taken early. So there are some exceptions to that 10% penalty, and we do want to kind of mention what those are. So if you have converted your IRA to a Roth IRA in the current year, that is a taxable transaction. You're actually taking a pre-tax account and now converting it over to a Roth account that'll grow tax-free and become tax-free upon withdrawal. That's going to be a tax consequence in the current year, but you're going to have a code 2, early distribution, but it's a known exception. Also, if there was a full or partial rollover to a qualified plan, hopefully it went trustee to trustee, which would be a code G. If not, then what may have happened is the individual had taken the money from their plan and they decided themselves to put it back into a new retirement account. And that could be an IRA at a local bank or a financial institution. As long as they've done it within 60 days of the initial distribution, it has to be 60 exact days. It's not business days, it's not working days, it is 60 days. Then that amount is not taxable. And we can go ahead and indicate rollover in TaxSlayer. There's actually a box you can check. Some other exceptions that are known would be a payment of an IRS levy. Your third-party administrator knows it's an exempt piece. It's going to go ahead and give you a code 2, meaning that we won't have that 10% penalty. If it's a death of the owner and you're inheriting, that's going to be a code 4. Again, you can be under 59 and a half and no penalty. Now, it could also be a total and permanent disability of the owner, and that's typically a code 3. If the party did not indicate a code 3, we may have to go and fill out a form 5329 and indicate total and permanent disability. If we have to go ahead and override the penalty, there is a section, it's going to be other taxes on early distribution. So what we're going to do is enter that part that's not subject to the 10% tax under part 1, and we're going to select a reason why that is not going to be taxable. And the codes that we typically use are going to be found on the following page, and also would be found on page H5 of your 4012. This is actually outside the income section and dealing with other taxes, but it kind of works well to show it here. So if we have a Form 1099-R, code 1 in box 7, the 10% penalty will automatically apply. If there's a valid reason why the penalty should not be instituted or reduced or eliminated, we'll have to use a Form 5329. And just want to go over a couple codes that could apply. Again, typically the recommendation would be to ask the taxpayer why they took money out of their retirement account. What was the proceeds used for? So rather than go through the list and say, did you do any of these following to get out of the penalty? We typically want to ask them first about how they use those funds. Now, we have had a couple of these situations arise in VITA. So code 05 would be if they have any qualified unreimbursed medical expenses paid during the year. We don't often see this. It's a relatively high threshold. It would basically be major medical costs. Again, it would be over 7.5% of AGI. Next week, we're going to be talking about some deductions and credits. So what we effectively mean is any amount that would be considered a deductible medical cost. You can take money out to pay for those, still taxable, but you would not have the 10% penalty. The next 3 codes, I just want to highlight the fact that we have IRAs indicated here. These are for IRAs only. It does not apply for monies coming out of a 401k or a 403b plan. So a code 7 would be an IRA distribution if you're taking health insurance payments for an unemployed individual. So if you're unemployed and you need to get health insurance, we're not going to really see this all that often within VITA because most of our clients are probably eligible either for the healthcare.gov or some other kind of state assistance plan. But if you took money out of your IRA for health insurance and you're unemployed, that portion can help reduce your penalty. One we see a little bit more of is code 8. So that's an IRA distribution, again, only from an IRA, not from a 401k or 403b, used to pay for qualified higher education expenses. That could be for yourself or your dependents. Now, when we talk about what those are, we're talking about tuition, we're talking about fees, books and supplies, any equipment that you might need, like computers or lab equipment. What's unique is we also include reasonable room and board. So all of your college expenses predominantly can be allowed to get out of the penalty or reduce the penalty for an early withdrawal from an account. Now, you do have to reduce any of these education expenses if you've gotten any tax-free scholarships or if you're doing the American Opportunity or Lifetime Learning Credit, which we'll talk about next week. Code 9, it would be an IRA distribution for a purchase of a first home up to $10,000 you can take out, and that would be not subject to penalty. So when we talk about purchase of first home, the definition is actually a little bit different. It's not technically the first time you've ever bought a home. If you would take a look at the IRS, it basically means the first time in a while that you bought a first home. It's not your first time ever. So it does have a little bit of leniency there, and you can take up to $10,000 out of your IRA. Again, just want to make you aware the $10,000 would be taxable, just not subject to the additional 10% penalty. Code 12 is a relatively new one in terms of the birth or adoption. So code 12 is where we put any other items, but code 12 specifically where we may see that a little bit more is for birth or adoption of a child. So up to 1 year after the birth or adoption of a child, you can pull up to $5,000 out of your retirement accounts. Again, those monies are going to be taxable, but they're going to be exempt from penalty. So if you do have someone who's taken money out for costs of birthing or adoption, they can take the money out and the first $5,000 would be free from penalty. So I know we've been going for about an hour here, so we're at a time now where we can take a break for about 5 minutes, come back around 6:40 p.m. Eastern time, and we'll address a couple of the questions that we've been seeing pop up here in chat and some ones we've gotten from our morning session as well. So let's go ahead and take a 5-minute break, give you time to stretch and formulate some questions. Again, if you have any questions, feel free to enter those through the chat feature, and we will come back in 5 minutes and go through our question and answer. Be a good time for us to address a couple questions that have arisen during our chat session here, and also bring in a couple questions we may have had from the morning session, just to help with a few questions that had arisen a little bit earlier today.
Okay, thanks for that. Can you hear me all right, Jared?
Yep, I'm all set, Jeff. How am I coming through on your end?
All good, thanks. So the first question, these are from the morning. Is inheritance taxable on state income?
No. So fortunately, gifts and inheritances will not be taxable for state purposes. So not taxable for federal, not taxable for state either.
All right. Next question. Does SSI for a child dependent count towards dependency?
All right. So kind of the question going back to last week was taking a look and seeing what the differences are in rules between support for purposes of a qualifying child or a qualifying relative. So when we talk about a child, the definition for a child is that they cannot provide more than half of their own support. So if a child's receiving Social Security benefits or SSI, and that money is put aside for their future education or put in savings, that obviously is not support that the child's paying. Also, typically the benefits that are being provided are not going to be treated as being provided by the child themselves. So typically for a qualifying child, we don't really have much issue with assistance programs coming through. Where we have a bit of a change is that if they do not qualify for a qualifying child, and instead would be trying to get under the qualifying relative opportunity, while these benefits are not taxable, so Social Security, SSI, typically not taxable and won't count against that $4,300 of gross income, those payments are typically going to be considered as paid by someone other than the taxpayer. So if someone is trying to claim their parent as a qualifying relative and the only income the parent has is Social Security, typically that's not going to put them over the $4,300 of gross income. But if all the money that's coming from Social Security is used to pay for the parent's rent or utilities or food costs, and the taxpayer only contributes a certain portion, less than 50%, then typically what's going to happen is that individual will not be considered a dependent because the taxpayer did not provide more than half of their support. Did that help answer the question, Jeff?
It did, thank you.
Okay.
Next question. This relates to a non-direct rollover. Will I get a 1099-R code 7 from the old plan? And then what paperwork would I get from the new plan?
Great. Yeah. So the question basically involves how do we handle a rollover? So if the rollover goes from trustee to trustee, basically from one employer over to your new employer or to an IRA account or a bank, they're going to fill out a 1099 code G, which means it's a direct rollover. It never hit the taxpayer's hands, never taxable. Now, we mentioned the scenario where you could have an indirect rollover, and that's effectively where the money has gone from the institution to the taxpayer, and then the taxpayer contributes that within 60 days to the new plan. In that case, the first party, the one actually giving the distribution, does not know whatever happened to that money. So they're required to actually report a 1099-R, and typically it could be a code 1 if the individual is under 59 and a half, or code 7 if the individual has met retirement age. Now, the one trick we have to watch is oftentimes that the employer may be withholding federal income taxes. If they do, then the individual has to roll over not just their net check, but the gross amount of distribution. So if they had $1,000 withheld out of an $8,000 distribution, they need to put $9,000 back in. I'm sorry. So if they're flying a little bit clearer, if their distribution was $8,000 and they had $1,000 withheld, they would get a net check of $7,000. The individual would be required within 60 days to put that $7,000 plus the $1,000 withheld for federal taxes back into an account in order for the full amount to be considered a rollover. So just some issue we take a look at there. We just want to be sure we're following the document trail. The initial issuer is going to issue a 1099-R. They're going to show $8,000 of distribution. $8,000 of taxable distribution, $1,000 withheld. If the individual has put that money back into an account within the 60-day period, they will not necessarily get a 1099-R corrected, but they should get a Form 5498 from their new retirement account. So they want to hold on to that. That's going to be their opportunity to go ahead and prove to the IRS that they actually did make a contribution to their retirement account, and probably have a canceled check to show that the timeliness. And that would allow us to then treat that as a qualified rollover for 1099-R purposes.
All right, got it. Thanks for that. Now some questions from the chat. The first one I'll take. So what do we suggest to a client when a preparation is outside of the scope? This happens from time to time. We're very frank with the client that the return has fallen outside of the scope and that we're unable to complete it. We do not offer suggestions about other services. We simply indicate we aren't trained and are unable to help them because the return has fallen outside of scope. I've done it myself many times. We set the return to deleted and send the client on their way. Michelle, was there anything you wanted to add?
No, I think that's it, Jeff. And we don't refer clients to any paid preparers. Unfortunately, we're not allowed to do that. So we just recommend that they check that there are lots in the area that may be able to help them.
Okay, thanks for that. Next question, back to the law material. What are the answers to the example in the simplified method?
Yeah, thanks, Jeff. Yeah, I apologize. I didn't go over the answers with our group here. It is actually an example that we have both in Pub 939 and also I believe it's in the 4471. But the correct answer would be if we go through the calculation for the simplified method. And that's basically using the tables to go through and double check what that would be. Bill's tax-free monthly benefit would be $100. So we take a look and on the joint life annuity, when we take the ages of Bill and his wife, Kathy, we'd have 310 as our denominator. He has $31,000 of basically employee contribution. So we take the 31,000 divided by 310. So that comes up to $100 per month. And that would be basically the excluded amount per month. So he'd get a $1,200 exclusion off of his benefit for the current year.
All right. Thanks for that. Next question. Will we see any CARES Act 1099-R distributions? If so, how they'll be coded and how do we treat them?
Sure. Yeah. So it brings up a great point. Actually, our next slide portion is going to be talking a little bit about what happened with kind of CARES Act coming through on the COVID changes to 1099-R distributions. Now, the technical piece, and I'll get into a little bit more right after we kind of fully get back in, is that was applying for 2020 only. So as of this point in time, we do not have an extension past any amounts withdrawn after the date of December 31st, 2020. So technically, we're not going to see any new ones coming through, and I'll talk a little bit about what happened with the distributions people had taken back in 2020 and a couple options that they had in terms of deferral. So I'll probably address that one in just a few minutes, but I'd be happy to answer any follow-up questions to that after the next segment here.
Got it. All right. Next question. RMDs were suspended in 2020. In 2021, does the taxpayer take their RMD for 2021 only, or do they need to take for both years?
No. So fortunately, when the RMDs came back in, it's only for the current year. You don't have to make up the prior year RMD. So it's only, they basically essentially said we paused 2021 RMDs. So we're only going to base it off of the account balance as of 12/31/2020 multiplied by your RMD rate. So you don't have to make up the prior year. It's only for the current year calculated RMD.
All right. One more question. The form 5329 code 8 must be for self or dependent, or could it also be for a grandchild?
Oh, no, fortunately, actually, it can be for a grandchild as well. So it actually opens that up quite a bit for individuals. So it can apply for anyone on the return. So obviously yourself, your spouse, your dependents, but you can also do that for grandchildren as well to go ahead and use the code 8. so you could have a situation, again, typically the penalty would apply if you're under 59 and a half. So I haven't seen it work on the timing that much, that you actually have people that would be grandparents paying for college, but it would apply if the ages work out. So if you're under 59 and a half, you're taking money out of your retirement account to pay for a grandchild, you would be able to exclude that amount as a penalty piece. And unlike the other ones, there's really no cap like we had for the birth of a child or for the first-time home buyer. We do have some opportunities there for basically whatever is paid for college education.
Got it. Great. Thanks for that. That was the last question in the chat.
Okay, perfect. All right. So what we're going to do now is actually kind of talk a little bit, and I'm glad the question came up about COVID-related distributions from retirement accounts, because we are going to talk about that here, and just kind of give you a refresher for what happened last year. So on D43 of your 4012, you'll see that there is some information that kind of talks about what occurred for 2020 distributions. So what that allowed was for people who had taken money out of their 401k, IRA, 403b, they could get a waiver of the 10% penalty up to and including $100,000 from those accounts. And I actually had a client last year who took $100,000 out of his 403b to go ahead and pay off all of his credit card debt. So not maybe something I'd recommend from a financial planning perspective, but they were able to take the $100,000 out and not be subject to an additional 10% penalty. So what we take a look at for the eligible criteria was fairly broad. Effectively, if an individual who was either diagnosed with COVID or had someone in their household, their spouse or dependent, diagnosed with COVID, or as a result of COVID, they experienced some sort of adverse financial consequence. So that includes the individual or the spouse or a member of the household, either being quarantined or being furloughed or laid off, or having hours reduced due to COVID, or being unable to work due to COVID, or having a business that closed, or reducing hours, or having some sort of self-employment reduction, or having pay reduced, or had a job offer, but that was actually either pulled back or delayed due to COVID-19. So it was a fairly broad definition of people who were impacted by COVID-19. So that only applied for distributions taken out by December 31st, 2020. So we have not seen any extension of that as of yet. Unfortunately, COVID-19 has still created disruption to work environment, to quarantining, furloughs, layoffs, reduced hours. We have not seen some industries come back in full. Some businesses have been forced to close. We've seen some, again, some more disruption in certain service-based businesses. But as of now, 2021 distributions do not have that same benefit. That 10% penalty will still apply for 2021 distributions absent any congressional changes. Now, in addition to the penalty relief, you also had the ability that you could only tax 1/3 of your income in 2020. So the year the distribution was actually taken, you could elect to only tax 1/3 of it, with the remaining 2/3 being taxed over the next 2 years. You had to actually do that with an election on the return. So technically, anyone who has deferred money and has come from outside VITA to the VITA sites this year would technically be out of scope. So if someone had chose to spread their distribution over the 3-year period, or had some sort of repayment after the date of filing the return, technically out of scope for VITA. But again, if you're preparing returns for friends or family, or your own return, and you've done that, you can certainly still use the VITA program. So if anyone has any repayments, that would be going on a Form 8915-F. But again, with the complexity, we did not have any clients in VITA last year that decided to spread that out over a 3-year period. So we're not anticipating that we have any returning clients that have that issue. So we may see it if someone tries to get in who had deferred it and has to repay it now, but that would be out of scope for VITA. In terms of some other benefits, and while we're kind of talking about Social Security and other retirement benefits, just want to kind of mention where we're at with the Social Security. So the Form SSA 1099 can be entered exactly as we've shown. Again, the main area we're taking a look at is again, I kind of keep calling it a salmon color. I'm not quite sure how close I am on that, but that the amount that we're showing in the shaded section on the 1099 coming from SSA, that's the amount that we predominantly would be working with, although there could be some supplemental information. I did want to also mention that we may have retired railroad workers. So you may have two forms coming through. One is called a retirement benefit tier 1. It's called an RRB for retirement or railroad retirement benefit 1099. It's called a blue form, and it's called blue for a reason because it's actually going to be blue. The tier 1 would be entered exactly like a 1099 from Social Security would be. So I wanted to give you two options. One is we can take a look and see that you can actually go directly to it by hitting Federal Section Income 1099R RRB 1099 RRB 1099-R SSA-1099 subset Social Security Benefits /RRB 1099, or you can just type in SSA in the upper left search bar and it's going to take you to that same area. So for either the blue form or the SSA 1099, you just enter it in that area exactly as shown. If you have the tier 2 benefits for railroad retirees, you enter that as a green form. Again, we have the way that you could link directly to it, or the way that I recommend is going ahead and doing the keyword RR. So the RR will take you directly to the input form and be able to go ahead and allow us to enter that information. So if you have a worker who would work for the railroad system, we just have two different retirement areas to entertain there. If you have any questions with Social Security retirement benefits, the D46 is a great tool to go show how that would be entered into TaxSlayer. A couple other things I wanted to mention about income would be capital gains and losses. So what we're taking a look at here would be if you have a sale of property. And what we're talking about is traditionally investment type properties, stock, mutual funds, or a principal residence. We may need to report some of those on our 1040. If we do have a capital gain transaction, we're going to have a couple new forms that pop in. We're going to have a form 8949 for each different type of transaction, whether it's short-term, long-term. We're also going to have a summary schedule, which is a Schedule D. The form D23 will walk through that process. Whenever we have a sale of capital gains or losses, we need a couple things. We need to know what the sales price of the asset was. Fortunately, that is typically reported on a Form 1099 or the Form 1099-S. We also have to understand the adjusted basis of an asset. So the Pub 551 will tell you what adjusted basis is. Fortunately, we're getting a lot of information from our stockbrokers or investment advisors that will show us what the adjusted basis of the asset is. We also have to identify whether it's short-term or long-term holding period. That's usually going to be indicated again if we have the 1099B, it's going to be broken down into various components. Good news is if you do get a summary schedule, we can just enter that summary information into TaxSlayer. You do not need to enter every transaction. In the past, I've had clients that have had managed accounts. They've had a number of very similar mutual funds. And in order to get their money out that they needed to cover their cash expenses, the broker thought it'd be a good idea to take $100 out of each of those, probably 14 to 15 accounts every month, which meant that we had multiple sale transactions, which would have been a lot of data entry. Fortunately, we could just use the summary schedules to enter that. And typically, we're going to divide that into either a short-term or long-term holding period. The other thing I just want to mention back on the adjusted basis of an asset, typically if you're getting a 1099B from a broker, they're probably going to go ahead and give you a couple different codes. If the broker has tax basis information, they're going to report it not only to you, but also to the government. And we're going to see a code generally saying code A, basis reported to the government. If they have the basis, but they're not required to report it, it's probably going to be a code B. And that is basis information is available, but not reported to the government. What we take a look at is just how you enter the information in Tax Slayer. Again, fortunately, with those categories, we have the basis, whether it's reported to the government or not, it's at least being reported to the taxpayer. We do have another situation, and I'll mention about that for what happens if we don't have basis. That's going to be a code C, means basis is not available or not reported. So we're going to have a couple issues that we need to take a look at there. We have to also take a look and see, do we have any capital loss carryovers from a prior year? Again, if the individual came to tax preparation here at VITA in prior years, that information automatically carries over. If they are new to VITA for the current year, the recommendation I have is to take a look at the prior year return. Take a look at the capital gains section on page 1 and see if they're reporting a $3,000 loss. So when we take a look at capital losses, you can only take up to $3,000 per year, and the rest is carried forward indefinitely. So if you see that there is a $3,000 capital loss, we may want to dig a little bit further, take a look at the Schedule D and determine, do we have any capital loss carryovers that are applicable for the current year? And again, as I mentioned, these are carrying forward indefinitely, so they can only be used up against other income up to the rate of $3,000 per year, $1,500 if you're married filing separately. But we do want to take those into account. Once we get them in the system, they should roll forward. I'm also going to talk a little bit about principal residence exclusions as well, but just want to go through a couple more pieces on the capital gain. So again, the Form 1099-B is going to be used for reporting things like stock and security sales. The 1099-S would be for the sale of real estate. We typically don't see a whole lot of 1099-S transactions unless the property is not a principal residence. If you were a co-owner, if it was a rental property or vacation property, then a Form 1099-S would probably be issued. We have seen those been issued for principal residence. Technically, they should not be, but in case they are, you would need to report that activity on the return. So much like everything else, if you see a 1099, be sure that information gets on the return somehow. So what do we have with basis determination? So basis is traditionally our original cost of the asset, plus it'd be anything that we pay, like our fees or commissions. Those are typically what we'll see on our stock transactions. The broker typically is going to report the cost or basis on the 1099-B unless they were not considered covered. So covered is just basically how long that security has been owned. In most cases, for most of our taxpayers, the basis will be reported on the 1099-B. So again, we talked about that code A. If it is reported to the IRS, if it's not reported to the IRS, we're going to show a code B. So it's just going ahead and kind of following the information we're receiving. However, we do have a little bit of an issue if we have that basis not known or basis not shown at all. The problem is, if we don't have any basis, the government's going to give us a number, and that number, unfortunately, is 0, which means the entire proceeds would be considered gain. And we know that's not necessarily the case. So the general rule of thumb, if you get a taxpayer who comes in and you see that the basis is not reported, we highly suggest that they take that form back to their current stockbroker or financial advisor and have them go through and help calculate a basis number for us. Now, we cannot create one for the taxpayer. It takes a lot of time. We may have to go back and do some research. We don't really have the tools nor the time to do that within VITA. We also can't make up a number for a taxpayer. We can take the number that they give us, or if their broker gives us a number, we're fine with that. But we cannot create a number for a taxpayer. We need to get it from them. So just want to be sure if we have one and the basis is not reported, we may take a little bit more time. That return probably will not be able to be completed that evening. For holding periods, again, we just want to take a look at the holding period aspect. If the period is held for 1 year or less, it's considered a short-term gain. Any of those gains are going to be taxed at ordinary income tax rates, so the same rate that all the other income would be taxed at. If the property is held for more than 1 year, we actually have long-term capital gains. Nice part about that, very similar as I mentioned about the qualified dividends, those rates are actually going to be a little bit higher, a little bit lower, I should say. So that can be as low as 0%. They're going to be lower rates than what your short-term or ordinary tax rates would be. So if you have property that's held for a long period of time, we may actually get no tax due on some of those activities. Now, again, going back to basis, just want to make a mention on when we talk about that whole concept of gifting versus inheritance. If you inherit property, and that would include stock or any other type of property, your basis in that property is the date of death fair value of the decedent. So when the decedent passes away, under current rules, their property that they pass along automatically steps up to fair market value of their date of death. So if they have stock that they've held onto for a long period of time, and they would have had a long amount of capital gain, that capital gain goes away when they die. It actually steps up to their fair value at the date of death. So at that point in time, there's no gain that would need to be taxed. Your basis steps up. Pretty easy to calculate. If you're gifted property, however, the basis for the gifted property is the same as that of the donor, the person that gave you the property. So if you do get stock or you do get something else in a gift, you have to ask the donor how much their basis was, because that's going to carry over. So again, we don't see that all that often, but just want to make some additional commentary on basis rules. Now, a couple other things that we take a look at for a principal residence. So typically, the sale of a principal residence would not necessarily be reported on the Form 8949 and Schedule D unless they don't meet a home sale exclusion or they actually received a 1099-S reporting the sale. So a little bit more information on the home sale exclusion is found on D29. The main rules that we have are the property has to be the primary residence for the taxpayer for most of the time. Well, good news is for VITA, we're generally not working with people that have multiple homes. So I've yet to see an example in VITA where someone comes in and you're asking about their home sale and they're asking, well, which home do you mean? I have a home here in Pennsylvania. I have a home that I go to for skiing. I have 2 beach homes. I have a rental home, a vacation home. Typically, our taxpayers here just have one residence. The rule typically is that you have to have owned the home for 2 of the last 5 years and lived in the home for 2 of the last 5 years. Now, it doesn't necessarily mean actually 2 straight years. It can just be any 24-month out of that 60-month period. There are some exclusions for people in nursing homes or a skilled care that actually drops down a little bit as long as the skilled care facility is an accredited facility and that they're there to take care of their condition. Temporary absences from the home like hospitalization or vacation will not cut into that 2-year rule. So as long as you're intending to go back, you should be in good shape. Now, these rules are technically separate, so the ownership and living in are don't have to be simultaneous, although for most of our clients it is. Makes it a little bit easier to deal with that. Now, the benefit of the main home exclusion is that the maximum exclusion is $250,000 per taxpayer. So if you're a single individual and you sell your home for $230,000 and you've lived there for 2 of the last 5 years, you've lived there for the past 40 years, you do not have any gain on the sale of your home. It's under the $250,000 exclusion, so there's no gain to pick up. If you're married filing jointly, that bumps up to $500,000 of gain, not your proceeds, but that's the gain on your home. That's the difference between how much you've sold your home for and how much you paid for your home. So for the gain of the sale of a main home, it's typically going to be our sales price. That's coming right off the HUD-1, the settlement sheet you get for selling your home. But you get to reduce that by any of your selling expenses, things like your commission or advertising or legal fees, any of your property taxes you're paying, your transfer taxes, those are all going to be deducted from the amount realized. In addition, your basis is whatever you bought your home for, plus whatever substantial improvements or additions you put on there. So you don't have to go back and say, well, I think I've replaced a couple light bulbs and put a couple cans of paint on. We're not concerned about those. What we want to take a look at are, did you completely redo your kitchen? Did you put an addition on? Did you pave your driveway? Those are all additions. Those are all substantial improvements that would be added to the basis of your home. Fortunately for VITA, I don't anticipate, even in today's real estate market, that we should be seeing people that have a significant amount of gain on their homes to be outside that exclusion provision. If they are, we do have to report that on the 1040 as a sale of property. and the IRS would tax any gain above those amounts as capital gain. So just want to go ahead and mention that. If you have a loss on the sale of your property, unfortunately, that's considered a personal loss and is not deducted. Okay, want to move on to kind of our couple last pieces of our presentation this evening. And we're getting into now a concept that's actually an advanced topic. So Schedule C or business income is actually an advanced certification. So if you're interested in doing that, certainly feel free to pay attention here, because we're going to cover a couple items that'll be important for preparing those. Business income is going to be shown on D18 of your 4012. Just want to mention that we would be preparing the form Schedule C. It is a form available within TaxSlayer. In addition, there's also a calculation that will follow this. It's called a form 8995-A. It's a simplified qualified business income deduction. It's going to give a 20% reduction, a 20% deduction, if you will, to taxpayers. It's coming out of a prior tax provision that has been modified. So currently that's still in the tax code. Effectively, what you're doing is only paying tax on 80% of your business income. Now, there are a couple scope issues we do want to talk about. So the following areas are outside scope for VITA for business taxes. Any amount greater than $10,000 in business expenses is a little bit more than what we can really handle. We're not really intending for people to come in who have a full-time job that they would like us to help prepare for their business. We probably would have to refer them outside. Typically, where we're going to see people with business income, and again, we've seen a little bit more in 2020 and probably a lot more here in 2021, are people that are doing side income or gig economy or side hustle type things. Traditionally, where we may see those coming in are going to be Uber drivers. Now we see a much more prevalence of DoorDash or Uber Eats. We see people doing some side work. Maybe it's doing some handyman services or painting or landscaping, that type of thing. So we'll talk a little bit more about the types of businesses, but we're not looking for people that are a full-time self-employed individual. So generally, no more than $10,000 in business expenses. They cannot have a loss from the business and still be within the scope from VITA. So there are some issues we have with hobby loss rules that just make it difficult for us to use a business loss within a VITA client situation. Again, they cannot have employees, so we're not going to deal with payroll. We're not going to deal with wages. They cannot use inventory. So they can't be selling products and holding on inventory. So that doesn't mean we can't have people that over the pandemic may have decided, I have time at home, I'm going to sell some crafts, or maybe I'm going to knit masks and sell them on Etsy or some other type of service. That's perfectly fine. As long as you don't have inventory. Inventory, what we really mean are things like grocery stores or retail locations that are buying things and they haven't sold them. Those are really the issues we have. If you have to count inventory and store things, it's really not going to be allowed. Other things we can't work with are farm income. So a Schedule F is not within scope for VITA. A lot more complexity. I deal with a lot of farm returns. So if you have questions about depreciation on the difference between a kind of a beef cattle versus milking cows versus goats, I can help you out with that, but that's not something we're going to be doing within VITA. Also, depreciation is also out of scope. For VITA clients, we do have depreciation opportunities within the program for TaxSlayer, but depreciation is going to be outside scope. Likewise, home office deduction. A lot of issues with home office. You have to have exclusive and regular business use. It cannot be used for any other purpose. So we are not going to be working with home offices at all within the VITA program. Self-employment health insurance, again, there's going to be some credits and other things that apply. So we're actually not going to be dealing with that within VITA either. Fortunately, when people call for appointments, typically 211, we'll try and screen for these items. I'll ask you a couple questions, but every once in a while, some of these will actually slip through, and we may have to go ahead and refer these people out to outside parties. So typically, we're going to see where the business income comes from. We're going to see a couple more areas of maybe reporting, and I'll take a look and talk to you a little bit about those. We may still have some cash businesses, so we'll talk about those as well. Importantly, when we fill out a Schedule C, it is going to be asking for a primary business. So what is the primary business that you're doing? If it's delivery services, go ahead and put delivery. It's also going to want a principal business code, which we do have a lookup function within TaxSlayer, which makes it very convenient. The reason for this, it actually allows the IRS to kind of take a look at the return and determine whether or not the business expenses appear to be reasonable in amount and customary for the nature of the business. So just want to talk a little bit about where the income comes from. So in 2020, we actually introduced a Form 1099 NEC, which stands for non-employee compensation. So if you're working for an outside provider, and the only people that have to issue 1099s would be businesses. If you're engaged in a trade or business, you would issue a 1099 for anyone who's doing work for you who's not an employee. So this may be applicable for Uber drivers, again, DoorDash drivers. If you're doing work, I've had clients that have done landscaping for a business and they're getting a 1099 NEC to report their non-employee compensation. That's going to be where it's going to show up. We may also see a Form 1099K. The 1099K is effectively a form that reports credit card transactions. So if you're getting paid by credit card, maybe you have a small site on Etsy, or you've developed a store on Amazon, or you're selling things for another platform like eBay, you may be getting a 1099K. That's going to report your amount of credit card payments. So these amounts would be taxable. So you need to report those on your Schedule C. Now, fortunately, if you have a 1099 NEC, you can enter that in TaxSlayer. It goes in under the income section under the Form 1099 NEC, or just the keyword SC, and you can link that to a new Schedule C. There's a screenshot on D17 that'll show you how to use that. Now, the Form 1099 miscellaneous, you might be familiar with that if you've been preparing returns for a while. Non-employee compensation will no longer be reported on the 1099 miscellaneous. It may still be used for rental income. Unfortunately, rental income is outside scope for VITA, but other income may show up on the 1099 miscellaneous. That could be things like prizes or rewards, or maybe if you open a bank account and they make a deposit, they say, if you open an account, we'll put $100 in. That's now considered other income. So that would be shown on 1099 miscellaneous. Those amounts are not business income. Those amounts would be reported as other income on Schedule 1, line 8. And I'll give you a quick reminder about that before we end our session. So obviously, if you have businesses, you probably will have expenses. The IRS will be looking for these. And really what we're taking a look at, there are a couple expenses that are going to make sense. They're going to be within the scope for VITA. The IRS, I just want to make a quick caution here when we talk about business expenses. A couple things I just want to kind of address. One is the IRS is a bit leery of cash businesses that show no expenses. One of the things we're going to be talking about next time is our credits and deductions. So the earned income credit is one of the biggest credits we have, particularly within the VITA program. It allows people to actually get money back from the government in addition to what they have already paid in. So it's kind of an advanced super refund. So you're getting money back from the government. Now, that's predicated on having earned income. So we haven't really seen it in VITA, but we just want to keep an eye out for it, where if someone comes in and they say, hey, I have a cash business, I earned exactly $17,842, but I have no expenses. I want to report that because I feel it's my civic duty as a U.S. citizen to pay taxes. But we just want to be sure that they actually have a business. We don't want them to come in and try and take advantage of an earned income credit that they're not entitled to. So the IRS is very, very concerned about earned income credit being used for purposes that were not intended. So I'll mention that a little bit more next week, but just want to mention that we do have, just be cautious about those types of items. Again, we haven't really been seeing it. If we do see it, we will definitely let everyone know. So again, we want to take a look at expenses. So the IRS will expect some expenses to occur with businesses, but they're going to have to be within a reason. They have to be connected with the business. I do want to mention that for a discussion with the client, we will take the information they provide us, as long as it seems reasonable and accurate. We do not need to see copies of receipts. We don't need to see detailed records. But we do want to remind the client that the information they're providing is going to the IRS and the taxpayer is responsible. So the taxpayer has to actually provide receipts and documents to support their figures in case the IRS decides to audit. So a couple of the things that are actually within the scope for VITA would be things like advertising. So when we talk about advertising, that can be printing up things like business cards or yard signs. Those are obviously advertising. What does not count would be people who are putting that little magnetic sign on the side of their car, and every time they drive somewhere, they're told, hey, that's advertising. That's not a valid advertising expense. The IRS will not allow mileage for driving around trying to get business. That is not considered valid advertising. The sign could be, but not trying to drive around and deduct gas and mileage while you're driving out to the grocery store and doing personal errands. Now, you can take car and truck expenses as long as we're using a standard mileage rate. So we highly encourage individuals to use a mileage log or a recording process to go ahead and keep track of their mileage. And I'll talk a little bit about some of our delivery drivers and how they can get that information a little bit easier. But there's actually a great chart within our 4012 and also our 4471 that talks about what mileage would look like. So mileage does not include commuting. It's not going from your home to your place of business. That's a commute. That's a personal expense. But driving around between business locations would be deductible. So that actually is a business expense that is valid. Any commissions and fees that people have, that might be credit card fees. If they're charging, getting charged by credit card processors, that'd be fine. If you have business insurance, or maybe you've increased insurance to go ahead and cover the fact that you might have passengers, that's within scope. Business interest, now we can't actually do depreciation, so we probably won't see necessarily business interest. But again, some of these we may not see that often, like legal and professional services. If you are using someone outside, maybe you had consulted an attorney to determine what's your legal responsibility for opening a business, that would be deductible. Office expenses, so if you have computer paper or ink or printers or things like that, those are going to be deductible. If you have to rent or lease a vehicle or machinery or equipment, typically we may see this for, again, a landscaper who may need to rent some sort of heavy equipment to move items or rent a trailer. Those are deductible expenses, as well as repairs and maintenance. If you have to have your computer serviced or you have to have some of your tools repaired or maintained, that would be fine. Supplies, again, we'll talk about that in connection with Uber drivers. But if you're creating crafts, any of the supplies that you're using to make your products would be deductible. Travel and taxes, we don't see all that often, but you may have licenses expenses. So people who might have a traveling nurse position or maybe a hairdresser that is actually going ahead and doing work, kind of what we call freelance, may have licenses that are required to be held by the state. They would be deductible. Travel expenses, again, for business purposes would be allowed. Meals, now meals are going to be a little bit unique here. So traditionally, for a meal to be deductible, it has to be in connection with business and you're discussing business with either an existing or potential client or customer. A meal expense is not for the fact that you are sitting at work and you're hungry and you're going to go through and get drive-through, you're going to order pizza in. That's a personal expense. That's just you having a lunch or dinner or breakfast. A meal has to be for a business connection. So there has to be something that would be going through. Now, a rule change is a meal typically is only a 50% deduction. So you enter the information in VITA, the tax layer program, and it's automatically going to limit it to 50%. But now there's a change in the rule that if you have a meal at a restaurant, and really to help encourage the restaurant business, so restaurant meals were actually 100% deducted. But if a taxpayer doesn't have a breakdown between 50% or 100% meals, we have a couple options. We can send them back and have them come back with the list, or we can just simply go ahead and treat it all as 50% meals. Again, we don't see all that often that we have meals coming through, but just want to show you a quick example of how things may change. A couple other things we have for utilities. We just want to be cautious a little bit about phones. So typically the IRS position is the first line coming into a house is not a business line. It's going to be considered personal. So we don't always have people doing landline deductions. I think where we typically have it would be on cell phones. So years ago when the cell phones first came out, the IRS would say, yep, okay, you have a phone. You can deduct any of your long distance calls or any of your specific charges for business purposes. That would be allowed. But now we see cell phone plans that are typically what we call bundled plans. You may have a couple people on a plan. So we can actually take a look at a cell phone and say, how much are you actually using your phone for? So if you have 4 people on your phone plan, it's $200 a month. Well, if only 1 out of the 4 phones is being used for business, that would allow you to start with $50 per month. But then we want to take a look and see how much of your phone's actually used for business versus personal use. So it's probably going to be less than 100%. So we can take the client's word on it, but typically we're going to go ahead and take something less than 50%. So oftentimes, you may have a phone because clients are contacting you. Obviously, when we take a look at drivers, they do need a phone for running applications, running their maps and everything else. So it might be a little bit higher for someone who actually has kind of a valid business purpose for that. So kind of moving into the Uber drivers or other car services that could include Lyft or DoorDash or other people, they are actually independent contractors for tax purposes. So their income would be reported on a Schedule C. And we would need to file a tax return if they have net earnings. And again, that's earnings after expenses of greater than $400. So typically a driver might be getting a Form 1099 NEC or they might be getting that Form 1099K that would include the credit card processing. So a couple things we take a look at is expenses that would be valid for drivers would be any of your car and truck expenses based on standard mileage rates. Good news is typically your driving apps will keep track of your driving miles. So you may have the client just go ahead and log into their service and pull down how many miles they have. That kind of works well for documentation purposes if they didn't keep track. If they have to pay credit card fees or commissions, that would be deductible. If they had to get insurance specifically for their business, that could work as well. If they have a car loan, then this may be where we see some interest deduction. But again, we have to take a look at how much of the car was used for business purposes versus used for personal. But the business portion of the car loan interest, not the payments, just the interest could be deductible. Office expenses, again, does not include office and home, but it could be keeping track of some of your, if you're printing off your reports or you're getting a scanner or things like that, that can be considered deductible. So supplies. So this includes things that you're using for your vehicle. Oftentimes a driver may have little snacks, mints or bottles of water or cleaning supplies that they have. Those are all deductible. And as we mentioned before, the business portion of the cell phone would be our deductible utility and allow us to go ahead and take that as a reduction of their business income. So again, typically we probably go ahead and suggest that they use their Uber page or their driver app to go ahead and pull down the expenses. Oftentimes that these driving services will indicate to the drivers what they should be keeping track of. And oftentimes the client can actually pull that down right off of their phone, and we can use that information moving forward. So a couple other things I just want to mention here is there were some changes to self-employed individuals for 2020. Again, similar to the distribution from retirement accounts. 2020 allowed individuals to defer their self-employment taxes until 2021 and 2022. So they didn't have to pay it in 2020. They could actually push it over to the following 2 years. There was actually an election made on the Schedule SE, which is calculated for self-employment taxes. That was on H1 of the Form 4012. Now, these taxpayers should be getting notices from the government that they owe money, and they can pay that directly through the government pay system. So those typically we probably won't see within VITA. Again, I don't believe we had anyone defer their self-employment taxes last year, so we're not anticipating seeing those. Another one I just want to make you aware of, although we probably, again, won't see this that often in VITA, would be a credit for a sick leave and family leave. So this actually was in 2020 and 2021. There's a special form that you can take as a credit against your self-employment taxes that you were unable to work or you had to work remotely because of a quarantine or isolation order. you were self-quarantined under advice from a healthcare professional, you had symptoms of COVID and you had to seek a medical diagnosis, you had to care for someone who was in that situation, or you had to care for a child because their school was closed or their care was closed. It gives you a credit against your self-employment taxes. So in case anyone has worked with that, we can actually do that within VITA, but again, it's a very rare circumstance and probably will take a little bit more time to prepare that return. There's also an opportunity for qualified family leave, and there's more information on page H9 of your 4012. Another thing I just wanted to point out that I'm seeing a lot more of here as we were taking a look at the COVID kind of quarantining is we have people who are taking advantage of our new relaxed rules on online and casino gambling. So I've seen clients now that have had fairly substantial gambling winnings. Client who had been at home, not working during COVID, had over $63,000 of gambling winnings from online casinos. That information was reported to her on a Form W-2G through her gambling app. Again, a Form W-2G will be reported to the federal government, so you do need to report that on your tax return. It's really kind of a less common item. We don't often see that, but you can put that in the federal section income, less common item, less common income. Unfortunately for that client, she did not hold on to this $63,000. She actually went back and tried to see how much more she could make and ended up losing all of it. So the fortunate part for her is that you can actually offset your gambling winnings with gambling losses, but there's a catch. The gambling losses are only allowed to the extent of your gambling winnings, and they have to be reported on a Schedule A as an itemized deduction. So if a taxpayer cannot itemize, they don't get any benefits for the losses. So for people who only want a little bit of money, maybe $1,000, $2,000, they're probably not going to itemize their deduction. So they're going to get stuck paying tax on their gambling winnings, even if they lost it later. Now, the good news for someone who lost $63,000 is that gives them enough to itemize their deduction. So we're able to offset her gambling winnings with those losses. And again, we'll talk about how we treat that for state purposes in our fourth session. If you have additional other items of income, that might be jury duty pay, again, the gambling winnings. It could be other income not reported elsewhere. So prizes and awards, like we mentioned, with the 1099 miscellaneous, that may still be showing prizes and awards in box 3. That's ultimately going to end up on our Schedule 1, and we have a couple lines that would be applicable for those. But you just want to ask the question, do you have any other income that we need to report, like jury duty or gambling winnings? Jury duty, not overly significant, but we would have to report that if it's disclosed to us by the taxpayer. Last item I wanted to kind of mention for this evening would be talking about debt cancellation. So again, when we talk about a pandemic, we have a couple different things that may arise. And part of that is people who have gone through debt consolidation. So if you have a personal debt canceled, it still may be subject to income. So when we take a look at the IRS definition, their code section 61, which gives them the authority to tax any type of economic gain. So that means any cash, any property or services received. So even though someone may not be getting cash, they got the benefit of using a credit card to buy things for themselves, whether it's clothing or a meal or vacation. They got some sort of economic benefit because they don't need to repay that. So if they have a canceled debt that exceeds $600, they're going to receive a Form 1099-C. And again, if we haven't taught you anything tonight, hopefully it's that the 1099s, if you get that information, should be reported on a return. So debt cancellation that we can actually perform within VITA would be any type of personal debt reported on a Form 1099-C. These other things, typically we're not going to see with that, but no interest related to that debt cancellation, not business related, and not under bankruptcy. If that's the case, then the entire amount of debt cancellation would be considered taxable income for federal purposes only, not for state and not for local. But any amount on a 1099-C would be considered other income and be reported on Schedule 1, line 8. Now, there is a exemption if you're insolvent. So what insolvency means is that you actually have more liabilities, that you owe more money than what you're worth, that you don't have sufficient assets to pay off your debt. If that's the case, then you may have some ability to exclude that debt forgiveness, but you have to go through an insolvency exemption process. There's actually a publication, 4731-A, I believe, that will go through some cancellation of debt issues, including whether or not you have something on foreclosure of your principal residence. So it's a lot more involved. If you have insolvency, we typically have to refer those clients out to the Mid-Penn Legal Services to help them with the insolvency determination and probably also helping them with their return. Now, we do also have some new student loan forgiveness that's actually within the scope here for 2021. Now, it's not all student loans. So you may be hearing in the news about student loan forgiveness. What we've been seeing is the only loans we're having forgiven right now for the federal government are for very specific institutions. These were ones that the government felt were very misleading in their promotional activities. They had mentioned that you could go to a technical school, you can make a lot of money, you're guaranteed jobs. So if you had student loan debt from any of those institutions that the Department of Education has deemed to be in violation of their policies, that includes things like ITT Tech, that student loan forgiveness is within scope for VITA and would not be considered taxable. So just wanted to mention a couple things on the debt cancellation, debt forgiveness. Again, if you see these circumstances, a 1099-C relatively easy to work with unless they're insolvent. We may have to refer them outside of VITA. A little bit more complexity if we may have student loan forgiveness or cancellation of debt in relation to foreclosure. But wanted just to go ahead and see how we're feeling at this point. That's all the information I had for our actual presentation. So wanted to go ahead and just turn it back over here to Jeff to see any additional questions we may have popping up here.
Thanks, Jared. Yeah, I have some questions from the morning session. Do you need receipts for any declared business expenses?
All right, so great question. So the answer is it depends. So we don't need to see it at VITA for the business receipts, but the taxpayer should certainly hold on to that for purposes of IRS documentation. So if they're going to go ahead and get audited, they would need to provide receipts for all of the business expenses on the return. As we mentioned, what happens is that those the information on the return is provided to us from the taxpayer. It's going to be their return. We're simply helping them prepare it. So what we want to take a look at is remind them that this is their return. They need to substantiate any of those expenses if the IRS or Department of Revenue from PA or even local decides that they want to audit the return. Typically, we would suggest that they hold on to those receipts for about a 3-year period. That just allows them to make sure that they have adequate coverage for their receipts.
Got it. Thanks for that. When does an owner have to issue a 1099 for payments of rent, subcontractor, et cetera?
All right. So in terms of 1099 issuance, we don't actually have to issue those unless we are in a trade or business. So it's only business owners that actually have to issue 1099. So if you have someone coming over and cleaning your home or mowing your lawn and you don't have a business, you don't have to issue a 1099. However, if you're a business owner and you have a landscaper taking care of your property, like a bank or commercial office building might have, then they're issued a 1099. So it's only really coming from a trade or business. So an individual does not have to go ahead and issue a 1099 to those service providers.
Got it. Thanks. Next question. For Uber, is there a minimum earnings before you receive a 1099 NEC?
Sure. So typically what we're going to see for the 1099 issuance is that you have to hit a $600 threshold. Once you hit $600 of earnings, and at that point, then we're going to see a 1099 issued for the individual. So it's usually a $600 threshold for the 1099 NEC. The 1099K, the government's actually talked about reducing that threshold, but around that $600 amount as well.
All right. Next question. How much winnings made by gambling turns it into a business instead of just a hobby?
Okay. So kind of an interesting approach. When do we consider something moving from kind of casual gambling into a profession? And we kind of take a look at that not only from a gambling, but we can also take a look at that from stock trading. When does a casual stock trade now become a day trader? And we're really looking at the frequency of the activity. Is it something that has given rise to the primary source of income? For gamblers, really, we have to take a look to see, are you a professional gambler? Are you actively engaging in things like tournaments? Are you traveling and paying entry fees for, say, poker tournaments? That type of thing. Just driving back and forth to the casino is not going to be considered a business deduction for you. If you have a trip you take out to Las Vegas or Atlantic City, is generally going to be considered a personal trip unless you are actively gambling and that's your primary source of income. So typically in most situations, we won't see anyone arise to a professional gambling status.
Got it. Thanks for that. Then some questions from the chat in the class tonight.
Yeah.
Clarification on the 3-year spread. I'll answer this one. Whether or not it was allowed for VITA that someone could take a distribution over 3 years. We never made a change. It was always not something in scope for us throughout all of last season. And we're hopeful that we're not going to see a lot of clients coming in this season having done that last year. Because if they don't have all the information, there'll be no way we would be able to complete the return.
Mm-hmm.
Moving on, sorry. Regarding businesses that buy and sell, buy items and then sell them.
Okay.
If they're using cash basis. For example, treating purchases as an expense in the year they make them and treating sales as income in the year the sales occur. Is that in scope for VITA?
Yeah, it technically is, as long as they don't have significant inventory. So if they're pretty much buying and selling in the same period of time, then that should be sufficient. The problem the IRS has is they don't want someone to buy a product, say in December, try and take that as a deduction and then sell it again the next January. So technically cash basis taxpayers, if inventory is a significant part of their business, cannot use the cash method of accounting for inventory. But if they don't really have much inventory, then we're probably fine allowing them to use the cash method for claiming their purchases in the year in which they've actually made the sale.
All right. Another business expense question for auto expenses. Do we allow the taxpayer to itemize auto expenses, or do we require the miles be used? If
Right.
auto expenses can be itemized, can depreciation be used?
Right. So we only use some mileage methodology for business deduction for vehicles. So we do not use, you can go through the actual methodology. Again, it's the kind of the question mentioned that we have that issue of depreciation. We cannot use depreciation within VITA. So the mileage method would be our method we use. It's much simpler in terms of getting the information from the client and doing the calculation.
Got it. All right, next question. In what circumstances would a person not be allowed to itemize deductions if they wanted to offset gambling winnings?
All right, so the question really, so it's not as if a person cannot itemize deduction. They may not get a sufficient amount of itemized deduction to outset their standard deduction. So as we mentioned last week, the standard deduction for individuals for single, and again, I don't memorize these. I know last year was $12,000, about $200. I think it's up to a little over $12,400 or $500 right now. So if they have an individual and they don't really have itemized deductions, they don't have mortgage interest, they don't have charitable deduction. And again, we'll talk about the itemized deductions a little bit more next week. But if their standard deduction is higher than the itemized, it doesn't make sense to go ahead and try an itemized deduction. You're actually losing money at that point in time. So the situation we have is that for people that have significant gambling losses or they have other significant itemized deductions, they get the benefit of offsetting some of their losses against the gambling winnings. But unfortunately for the casual gambler, you know, maybe they hit big on a scratch off lottery ticket, maybe they won $5,000. That in and of itself, you know, we have a choice of taking a $5,000 deduction or a $12,400 deduction. We're better off taking the $12,400 deduction because the standard is higher than the itemized deduction at that point.
Got it. All right. Next question. Rental income Schedule E is out of scope. Does this mean that K1 income with the Schedule E is out of scope as well?
And I'll defer to you and Michelle on that. I believe the official position for VITA is that K1s would be out of scope. They are a lot more complex, particularly depending on whether they have business activity or self-employment earnings, or they have other capacities. But I believe typically the K1 would be out of scope for VITA clients. However, as we mentioned, if you have friends or family or a personal return, you're more than welcome to use the tax layer program to calculate depreciation, to enter a Schedule E, to do a K1. But I'll defer to you and Michelle, Jeff, there on the official position from VITA.
No, you're absolutely correct. That is our position. While some may be simple, as a rule, they're out of scope unless they're friends and family. Thanks for that. And that was the last question I had in the chat.
Oh, perfect. Okay.
So I have a couple of closing remarks. We talked a little bit about family and friend returns. So just as a reminder, you can do as many family and friend returns as you would like. You cannot be paid for any of the family and friend returns and do them under VITA. If you do family and friend returns, no scope limitations. You can do K1s, you can do Schedule Es, you can do rental income. Anything you are comfortable doing, you are allowed to do, and you are not required to have a quality review. We tag those returns on the finishing screen as family and friends. That way, if the IRS were to come in and audit us and they don't see the note that that was quality review, they'll understand why. The other update that I have is we will be offering in-person computer lab sessions. So we're in the process of finalizing that with Millersville. We will get that out to you probably next week with what that schedule will look like. You'll need to sign up. There'll be a limit to the number of people that can be in the in-person session. We will also offer computer lab sessions as virtual, just like we did last year. Tomorrow, the recording will be sent out tomorrow. And other than that, that is all I have. So if there's no additional questions, Jared, Jeff, do you have any closing remarks? If not, we're calling it a wrap. All right. Thank you, everyone. Have a great rest of the week. Remember to get your 4012s and your 6744s.
All right. Yeah. Next week, we're going to be talking about credits and deductions. So it should be an exciting time. So look forward to, I'd say see you all next week, but you'll probably just hear me next week. So looking forward to our next discussion.